Welcome, guys. And today we have someone from traditional finance. We have Vishal with us, and we're going to discuss a little bit more about options and have some better insights to options from the traditional finance perspective. So, Vishal, can you introduce yourself?
Hi, I'm Vishal Kankani. I come from traditional finance, spent about 10 years or so trading, structuring, managing risk across investment banks and prop shops. Currently, I work at Deutsche Bank in their equity derivatives division. Yeah, so have been dealing with derivatives for the last 10 years or so.
So options is one part of derivatives. Like derivatives is just an umbrella term. So you have different types of derivative products, and options is one of them. What would you say is the biggest difference between options and the other derivative products?
Well, I mean, there are lots of differences across lots of products. Just to give you an example, like there are so many derivatives like futures, swaps, options, etc., etc. For example, what differentiates options from futures is like the non-linearity. Like when you buy a stock, if it goes up $1, you make $1. If it goes down $1, you lose $1. But when you enter options, or like same thing with futures, like if it goes up and goes down, you just make and lose the same amount of money. But with options, every single dollar the price goes up, you make different amounts of money. We can enter into the sensitivities later why there is this non-linearity. But I would say that is one big factor. And the other big factor is you can construct it in a way where there are scenarios where you do not, lose a lot of money. I mean, you can obviously trade it in a bad way and lose a lot of money. But like with futures, there is no defending yourself from losing money if things go against you. And you could lose a lot of money. In options, except for a few situations, if you're reasonable, then you should not lose a lot of money.
So options is a little bit more flexible, in which we can structure it in a way where it shows the kind of risk appetite that we have. So if we're very, very risk loving, we can structure it that way. And if we're very, very risk averse, we can structure it that way. So it's a bit more flexible.
Correct. Like I will say, using options, you could think of as like a building block. With a combination of options, you can pretty much construct any kind of payoff that you want. And it's something like, you go to a suit shop, you can either buy off the shelf suit or you can actually get it customized. And, using a variety of options enables you to, get a customized payoff. And why is that important? We can go into the philosophy why options originally started. It was like derivatives mainly are supposed to be a hedging instrument in the beginning days. And if you are a big pension fund person or an insurance company or a sovereign wealth fund, and different types of institutional clients or retail clients, you have a risk profile across decades sometimes. And to attain a specific hedge to those kind of different risk profiles, options come in very handy.
So it's good that you mentioned, buying a suit customized and buying a suit off the rack. And that is very reflective in the kind of option structure and option pricing. So we delve a little bit back to looking at how do you price options? When you price options, these are basically premiums. So how are these premiums priced in the traditional financial market?
Right. So, for example, taking an example from equity derivatives, right? Because GameStop was in all the story recently. Just let's say I wanted to buy a call option on GameStop. So a call option is basically which will make me money when the price of the stock goes up, right? So obviously the price of the stock is one variable, right? Now, if you think about intuitively, if the stock is way, way volatile, there's some higher probability of it, being so high that I can make a lot of money. When can that happen? When the stock is very volatile, right? So volatility of the stock is another parameter. The other parameter you would think intuitively, if I give you like 10 years, there is such a higher probability it can go in the money, right? Versus if I give you a 1 hour option. So time is another variable. These, I would say, are very important variables. Then there obviously is an interest rate variable where you would say, okay, the 5-year rates are 2%. So then that would define the forward price of the stock. And because your option is struck at maturity, right, in the European cases, so interest rate would be a variable. Some stocks also pay dividends. When the stocks pay dividend, the stock price goes down. So effectively, it's kind of a stock variable, but it has a separate place in the thing. So, and then there are a few variables, like as the option models keep getting complex, but these are among the popular ones.
Okay, so you mentioned a lot of different terms. Let's break them down. So the first one you mentioned is the underlying, right? So GameStop and the change in GameStop prices. So one thing that will affect the options of a call option of GameStop is when if GameStop changes very quickly, or GameStop, the underlying GME itself is changing, that will affect, there will be a variable to affect premiums.
Correct.
Then the second one will be the volatility. So the volatility means how much it changes or how quickly it changes. So if it changes super fast, then option prices will also change respectively. So if it changes, if the volatility...
think about it, right? If the stock is very volatile, the distribution of the future prices is wider. If I say there is this stock which never moves, I mean, there is no stock like that, but let's say there's a stock which hardly moves, then the distribution of future prices is very narrow. So when you're pricing a call option, the situations where you'll be making 5x or 6x is very limited. So if the probability of those outcomes is kind of low, your payout is also very low. So the distribution of future prices is affected by the volatility, and hence volatility is a parameter.
So if we look at it from a retail person perspective, options is almost like a very educated gambling instrument, because we are gambling when we're buying a call, we're gambling that the prices will go up in the future. But this is an educated gamble, because an educated prediction, because if the underlying stock is very, very volatile, then the probability of it being the very high in the future is higher than of a stock that it's not volatile. So it doesn't really move that much. So the higher the volatility, the more expensive the option prices would be.
There's one subtle point to add there. I mean, for example, same can be said for futures, right? Like higher the volatility, higher the upside and higher the downside. The difference with a call option in our example is when the stock goes really down, you have bought a call option. So you don't lose because you have the right to buy. And because you don't lose, your negative outcomes are like very good. So hence the option is expensive on the upside. Like, for example, if you had a future, then you literally are taking both sides of risk, on the upside risk and the downside risk. And that's why volatility actually only favors you in the positive outcomes. And that's why the prices are correlated with volatility.
Got it.
And positively correlated. Yeah.
The other three things that you mentioned, the first one is time to expiry. So obviously, the longer the time, then the more expensive it will be, because there's more time for you to be at the kind of outcome that you're looking for. So the second one is interest rates that you mentioned. So interest rates, it's more like opportunity cost, is it? If I put money in something else, then that's where the money could be getting some returns instead of options. Would you say that's how you see interest rates?
Sort of, yes. But you can also think of it like this, right? Eventually, if I say the interest rates are 2%, okay, a 1-year interest rate, and your stock is trading at $100 today. And let's say as a parallel example, you have $100 in your wallet today. So if you don't take any risk, or like call it the basic minimum risk of buying a 1-year note from a corporation which is very highly rated or a very reliable government, you are expected to make $102 next year. So when you do this, what you have said is basically, as you mentioned in your words, opportunity cost, right? In a way, the forward of the stock, assuming there is no dividend and there are no other funky things going on, the forward price of the stock in that world, in the risk neutral world and stuff, would be 102. Right? So the call option that you are going to value at maturity 1 year from now you are expecting the future price, like the forward 102. So then the payout is 102 minus the strike of 100, so $2, right? Now just take the same example and turn the interest rates to 5%. Your future price of the stock 1 year from now is expected to be $105, right? Because that's the risk-free bond giving you that price. So then it's $5 when the rates are 5%, right? And hence you see that it's positively correlated to the interest rates as well, the call option prices.
Okay. And the last one would be the dividends. So having dividends actually lowers the price of the option.
Correct.
Because you get to gain from the dividends part. So the output will be...
You don't gain. Only the stockholder gains. If you just buy a call option, you don't have the stock.
That's true. Yeah. So why would dividends lower the price of options premium?
Yes. So when I buy the stock, right, for $100, and let's say the same stock was going to give me $1 dividend between now and 1 year. So when I get $1, before the dividend is paid out, that $1 is priced in the whatever the stock pricing model is, right? Like you use a DCF model or some other types of models. When the dividend is taken out and it's paid to the stockholder, suddenly the remainder of the cash flows, etc., of the stock pricing model are $1 lower. So the stock price goes to 99, right? So as a stock owner, I don't like lose anything per se. I get my dividend and then $99 of stock is still with me. So I still have $100. But from an option holder's perspective, he doesn't get the dividend, right? So why would he pay for a call option where systematically the price will be $1 lower within the next 1 year? So that's why he will pay a cheaper premium, because the market is pretty efficient, at least in our side of the world. So he'll be like, okay, you should pay less to buy the same call option. So you see the interest rates are working on the upside and the dividends are working on the downside. And if you ever open the pricing formula for options, like Black-Scholes, which is like the holy grail or has been the holy grail. I mean, obviously that's the starting point. There are much more complex models beyond that, but you will see these things. R is positively correlated and Q is negatively correlated.
So that's a very good point, because it allows us to compare between traditional the capital market as well as the DeFi growing market. So DeFi options is still quite new, actually. There are a few protocols out there with looking at creating new structures of options, looking at new ways of trading them. And one of the biggest, not problems, but one of the biggest things to consider is pricing these options. Because when we look at these crypto products or these cryptocurrency coins, we have very high volatility, so option prices will go up. The underlying also changes quite fast. So the change in the underlying stock, as you compare before, that's also quite fast. And so how can we even get started with pricing these different crypto options, like options for these crypto products? Because we don't have interest rates, there isn't really dividends per se, and the volatility is so unpredictable.
I mean, I don't think most of these things are problems. Like, it doesn't matter. Like, the formula doesn't say that your vol has to be below 50%. You could have a 150 vol stock if you want. I mean, and you have all the biotech stocks. If you just go and look at their vol, it's crazy. Some of them put even crypto to shame. And then there are options to them. Then for stock price, yeah, same thing. It moves, volatility, no problem. And again, actually, there's also a difference between how you price options in FX versus how you price FX options in equities. Because one of the basic differences is, like, in FX world, you are trading one currency with the other currency. So any which way it goes, the volatility increases. So there's a vol smile. If there is a, how do I say it? There's a vol curve for, like, so if the thing is, like, if the stock prices goes at 150, what the volatility would be? What if the stock price goes at 200, what the vol would be? So in equities, generally it's a declining curve. And what happens is, when equity markets crash, the vol goes up.
Mm-hmm.
When I say vol, it's volatility.
Mm-hmm.
And when equity markets rally, generally the vols go down.
Mm-hmm.
So you would see that declining curve. So that is one difference. In FX, if you talk about Euro USD, doesn't
Mm-hmm.
matter if Euro goes up or dollar goes up. In one way, there is volatility. So that you see that kind of smile.
Mm.
That's one thing I know of, and I'm sure there are more differences when it comes to pricing FX. So that will always be the case.
Mm-hmm.
What will be more complicated in pricing options in crypto is, and just from a traditional perspective right now, there are crypto specific issues that happen. But jumps, like, when I said Black-Scholes is where you start.
Mm-hmm.
And then there are like Heston models and like more complicated models. There are jump diffusion models as well. In crypto, it's not only about volatile. Sometimes jump function, like look at what happened to Ripple. Mm-hmm. When US, said, it looks like you're a security and you should be fined more than $1 billion or something. The thing just literally collapsed. Mm-hmm. Similarly, something happened with a token called DMG or something recently, and it collapsed overnight. Pricing such crash risks, right? Mm-hmm. And it's not to say that, oh, these were the only two things for them, this could happen. Tomorrow, if something critical happens at an infrastructure level of a very well-known protocol, you could see those kinds of things, right? So how to incorporate jumps, and I think that's still not a difficult problem. It could be easily added, or you could approximate the things. What gets more complicated now, crypto native problem, is forks. So how do you treat forks when, let's say if you had a call option on Bitcoin and Bitcoin forked into Bitcoin and Bitcoin Cash? I can think of ways and I can suggest very quickly on the top of my head, but how do you actually execute them? That's going to be a problem. And in DeFi, in fact, I remember I was talking to a bunch of derivatives people in crypto last year. This wall curve I keep talking about. Yep. Generally, there's one wall curve across calls and puts. Mm-hmm. And there's something called put call parity. It's just a formula. You don't need to go into details, but it kind of keeps the market arbitrage free. Mm-hmm. A year or two back, when I was chatting with some options traders in the space, they were like, we currently don't even have one wall curve. We have two wall curves, one for calls and one for put. And that is ridiculous. It was ridiculous. And I understand because there are liquidity issues. The market is very nascent. But I think with the rise of Deribit and a lot of other OTC desks and players like Genesis, Ledger Prime, etc., I think the things are getting much better.
Yeah. And we have you mentioned a lot of different things and there's a lot to unpack. I think the first three things that, before we move on to another topic, is that, so the first one is FX and equities. There are option models for FX and equities. And this is quite important to look at because some crypto assets or products are more towards FX and some are more towards equity. So, for example, like Bitcoin. Bitcoin is it's not exactly equity, it's more like FX because some people treat it as
FX, currency, commodity, something like that.
Yeah. So that will be a very different kind of mechanism to equities. And that makes a lot of sense because there isn't one like be all and all model to be pricing all these different option products or option premiums. And to use that to be pricing all of them is really quite unfair to a person purchasing the options because it's not being priced properly, either to the seller or to the buyer.
And I would agree. Yeah. I'll just say we are way too early to even start discussing that point. But yes, I would agree. I can see that happening, this separation happening. Yeah.
And one thing you mentioned Deribit, you mentioned a lot of OTC desks for premiums, for option premiums, as well as it's more like CFI, right? Centralized finance or decentralized finance space. And those are using, you have more sophisticated players coming in to be pricing them. And then you have an order book and you be matching your buyers and sellers. So that is the way it's being done in the centralized, decentralized finance world. And in the decentralized finance world, because these things are quite complicated, what a lot of these products or projects are doing is all you have to do is to add your strike, add your expiry, add your underlying, and then choose a call or put. From there, you derive a premium, and then you can be just purchasing these options option products as an insurance or as a call to betting that the market is going up. Like, how can we make this DeFi options pricing model and premiums model a bit more efficient in that way?
Oh, I mean, you're asking $1 billion question. So I like, so there are people like, there are apps like Opine. I talked to somebody from Opine who was previously traditional finance options trader as well, I think. I talked to another app called Potion. Like, they're also trying some different approach. So all I would say is there are a lot of smart people in this space.
Yep.
Actually attacking this problem, and this problem is very tough because when you're talking about, like, let's say an options like Opine, right? How do they source the price? They need to get a model, right? They need to also have some kind of liquidity on the other side to take your thing. So, and if you ever were to mix this with like an automated market maker kind of construction in Uniswap or 1inch, or pick your favorite AMM, you only have spot as one variable. The price goes up and down. But now you make a liquidity pool where the prices go up and down, where the volatility can change, where the interest rates can change, where 10 other things can change. I mean, well, 10 is too much, but you can stay with 3 or 4. It's like a multi-dimensional problem to begin with.
Yeah.
And I just think it's a tough construction to make. I mean, will they be able to make it, or a new app will come and do it, or there will be some kind of convergence between CeFi and DeFi? Like, everything remains to be seen. But yes, and even if you construct something, the bigger problem then would be like, are you sure you can get liquidity to that app? Like, getting a liquidity to one of the spot AMMs is a different thing versus getting a liquidity in an options market protocol. And if you cannot get a proper liquidity, the risk can really blow up. And if like the problem with when I say the options are customized, non-linear, very good at hedging risk. If you don't hedge it properly, it can like literally blow up in your face. So it's going to be a delicate problem. I don't expect personally a very quick solution to this. It might take some time, a few months at least, maybe a year or two.
Yeah, for sure. I think one of the biggest things that DeFi needs to start understanding better is risk management, because like you mentioned, honestly, to find liquidity in DeFi is not that difficult because a lot of people are just very attracted by the APYs and they're happy to risk and try out new protocols and be part of this experiment. And I think that's a good philosophy to start with. But from a protocol's point of view, it's about risk management. It's about how do you reduce the risk of liquidity providers or these people who provide liquidity? How do you make sure that you hedge away a good chunk of risks so that you only give certain kind of risk exposure to the different users in your space? And
I'm not sure. I mean, that would be ideal, but I'm not sure if the app has to do the hedging for the liquidity provider. I mean, if liquidity provider can choose to do market make based on whatever the curve they offer, or can make his own curve, but I don't think it's a job of the app that will it's like, Robinhood lets you trade options, but Robinhood doesn't hedge it for you. So if we make a DeFi app where somebody can come and trade options, then great, but do your own hedging. So I won't be that harsh on the apps. I would, even just to make markets in a proper way is difficult. Forget about the hedging part for now.
Because when we talk about like AMMs and to be a market maker, there are a lot of these impermanent laws that's being mentioned all the time, and basically it's just another opportunity cost, right? Because opportunity cost, you put money somewhere else and you can make money depending on the risk, the volatility. There is a threshold, there's a range in which the asset is volatile within a range, and you make money as liquidity provider in an AMM. But outside of it, you better put your money somewhere else or put it in a wallet. Don't touch it in the first place. So do you think that's also part of what, like, the Robinhood app should be the one managing that, or that's really up to the liquidity providers because they choose this risk?
So if I understand, is the question like, should the app be also integrating the hedging feature?
Yeah.
Or I mean, if they could, it'll be great, but I don't think they have to.
So
Like,
a
it's
lot of
the option. I mean, person who's trading options, like the taker guy, he probably is just, or she probably is just speculating or hedging some existing position, right? And the person who is making markets, I mean, has to run some kind of either just accept, as you said, right? Like there will be some kind of impermanent loss that you'll deal with, which could be massive. I don't even know how to measure that in options right now in AMM construction. And you'll make some APY, right? And that should potentially offset your impermanent loss. And if you're selling call options, then like be careful. And also like the currently the construct, if you're going on one of these apps and buying an option or selling an option, you probably are like getting not a great price, because we are so early. There is so much spread in those things. I was looking at a few of these prices. I'm like, this is ridiculous. Like
good or
these
bad
are the
ridiculous?
prices, bad ridiculous. Like I don't want to trade options with those prices. And I mean, like, and I don't feel that anybody's actively trying to rip you off. It's just they are difficult. You cannot just blow up your money by giving tight prices. Even like, as I said, like 1 or 2 years back, even the centralized finance, which was being run by like some of the very knowledgeable options market makers, was having 2 different volatility curves. Now imagine there's an app that's going to make markets for you. It's just ridiculously tough.
Yeah, I think options is still quite, like, options in capital market is really super tough. I mean, you guys are a lot more efficient, but to price them properly, it's still quite tough. And there are a lot of different matrix, like general matrix that can be applied into pricing these options, equity options, for example, that we don't have those in the DeFi world. Like there is no VIX yet. There isn't a lot of these general matrix for us to understand and price them better. So what do you think would be, the top 3 matrix that can be introduced to DeFi that can make pricing a lot more efficient?
I mean, I understand there is VIX, but I don't understand why VIX makes option pricing of, for example, Google stock any more efficient or any less efficient. Right? Like these are independent constructions. VIX kind of it in itself is a different, you can call it like an asset class. Volatility, like traditional markets are so mature. Just to give you like one side example is like, I could trade billions of dollars of notional of calls on, or call spreads on something like S&P 500 index, and street would clear it within a couple of basis points. I'm talking about 0.01%. It is that efficient, right? And for those things, yes, VIX is kind of a proxy, because that VIX is essentially, and then you can also trade VIX just to have a view on the uncertainty of the market, a view on the, or just collecting the premium that volatility gives you. So you can have something like VIX in crypto. We can maybe discuss what those things could be, but that would just be another additional way to introduce options, like or make money, or have a tailored exposure. Like some people just say, hey, I don't want an exposure to stock price or the crypto price. I want an exposure to the way. And for those kind of things, you can also have some things like variance swaps. I mean, they are not options, but like variance swaps are a type of derivative which is a very clean exposure to volatility. And how do you now make, for example, the VIX equivalent in crypto for Bitcoin? Now you have to first pick an index for what? Well, Bitcoin's wall is Bitcoin's wall. There is no VIX. So VIX, okay, maybe the users in crypto may benefit from knowing what actually VIX is. So VIX is an estimation, like an implied so you have these 30-day maturity, and there's the S&P 500 index. What VIX is saying is the implied vol. So volatility, there are two types of volatility: implied and realized. As the time series, what happened in the last 1 month, you just take a statistical number and you'll just find the realized vol. Implied vol is where the option is trading based on where it is trading. If you were to plug in the Black-Scholes formula, for example, you will back calculate for this vol parameter with the price known. And this is what market is implying. And VIX is on a basket of stocks. So market is saying in the coming 30 days, I believe, or we believe as collective market, that the vol should be 25, implied vol, right? But then there is a basket of stocks here. If we are going to talk about Bitcoin, you don't need VIX, right? Bitcoin is just Bitcoin. You just, Bitcoin is trading at whatever price in the options market. You just back calculate for the volatility of Bitcoin. That's it. But what you could actually ask is, hey, what about a DeFi basket, right? Like you can make for example, this is good, right? Like you could take a DPI, right? The DeFi Pulse Index. It's it has X number of DeFi popular names, and each of them are having their own realized vol. Each of them are having their own implied vol if they have an options market. Then you can standardize that. There will be some kind of standardization, which is not a difficult problem in given a few months. And then you can say DIX, for example, DIX instead of VIX, and you'll be like, all right, the DeFi implied vol for the next 30 days is trading at 65. And then you can start actually harvesting your views on the volatility of DeFi as a sector. And that's how people who are very deep into crypto and specifically DeFi can actually start hedging themselves. And you were right earlier when you said, right, like in crypto is so big that Bitcoin may gravitate towards commodities and FX kind of pricing. And a lot of projects in DeFi, for example, something like Uniswaps or Compounds or like Aves of the world, right? They are literally generating cash for the protocol. And they're, some of them have also said, like, you could use metrics from traditional finance, equity, like price to sales and a few others. You can maybe use the DCF model if you want to of some sort. So similarly, yes, you could use the VIX of some sort for that kind of complex of DeFi, and that would help.
So actually, as you're talking, one thing that came into my mind was, are these complicated derivatives created because the market is getting more sophisticated, or we create these products like the DIX or VIX of DeFi to cater to get more institutional players coming in, to get new sets of players coming in?
So it works both ways, right? First, people want to make money, right? So some people, and some people want to hedge risk. And when the confluence happens, everybody wins. So today we are so young that we don't see the future needs. Like, why are people trading wicks? Like, because they literally have exposure to the vol. Like, they could run delta neutral strategies if they want to extract vol premiums and stuff. And it, as I said, like, variance swaps is a very clean way to get exposure to volatility, right? So there is a demand in the market. Somebody either from the hedging side or from a speculative side. It could come from both sides. People want to do that. And there are way more complicated vol products I can talk about, but I don't think we need to go there right now. And that is purely speculative, I think. They just want, so they go into complex products. But on the other side, if I am a engineer or I am a quantitative person who can create something that the guy wants, I can charge fees on it. I can license it out and I can collect fees on it. So, a lot of people, what they do is they create these indices, and then they license it out. And then whoever trades on it, the creator of the index gets some basis points of fees on that. So they make money. Right?
So wait, like you create an ETF and then you can license that ETF as an index?
Yeah. So S&P 500, for example, right? The SPY ETF. It has this management fee. If you go and check every ETF,
the
has a
management
management fee. So
Yeah.
what they're doing is, say, listen, you guys want this. You want exposure to the tech sector. You want exposure to the US equities. We'll create it for you and systematically get it done. And you just pay us 5 basis points, 10 basis points, 1%, depending on the ETF. So you need some kind of organic high demand, either from hedging or risk or speculation, and the other side, desire to make money. Like, this demand should be big enough that people would want to create products like that.
So what's stopping, if let's say, because SPY is out there already, right? So what's stopping another person from creating the exact same index basket and charge a lower management fee?
Yeah, you could.
Okay, then wouldn't that, because
I'm telling you, the billions of dollars are getting cleared at 1 or 2 basis points. So people have figured it out. Like, people have already compressed the margins. It's really difficult to trade at good margins. Like, right now, you could look like spot was trading in crypto like a few years back, 1 percentage point maybe. Now it's trading in like a few basis points, if at all, for like small sizes. So everything is gonna get compressed.
Yeah,
and it's not only about the expense fee, it's also about the construction. Right? These become very complex. They're not very easy to calculate, and like you need somebody who is reliable, well audited, and stress tested methodologies. So if, let's say, you and I started a company and created a vol index, sure, it could be better product. We'll need a lot of marketing. We'll need a lot of firepower and reasoning, and it's not easy. And I think, if I'm right, I think I heard like 2 years back, there was an alternative that came 2 weeks. So it's what you are saying, it's not unheard of. I just don't know currently what the status of that is, but it did come.
Okay. Because if we go back to the pricing these management fees again, and considering that, especially in crypto, everything is transparent, it's no one's stopping you from taking one of the models that's out there and then copying it, reducing the management fee. And at the end of the day, it will be a very efficient market with zero management fee. And that's not actually good for people creating these indexes.
I mean, yeah.
Like, will we ever go to that situation where the management fee is zero because it is efficient?
But think about it it's not management. It's more like so management is for the assets, and licensing is for providing the value, right? So when you say CME futures mark, right, that mark gets published at the same time every single day. I think it comes from a company called CF Benchmarks or Crypto Facilities, which is owned by Kraken. And they must be getting paid the licensing fee for giving that number. So if an equivalent if let's say the same team created a VIX index for DeFi, and they published it on CME, and CME allowed options to trade on that number, then they will pay the licensing over there, and that would happen.
Okay, so it's really paying for the intellectual property of the number than the management of it.
Right, like just to give another example, right? Like, Bitwise Asset Management, they have created their own indices, right?
Yes.
And they are getting assets now, and they're going to charge that management fee on that. Then you could think of DPI, for example, the same DeFi index, right? At some point, or like, they already have to collect some fees out of that, and that's how. Then you could say, hey, if they have this index which is transparent, then why can't somebody just copy it? Yeah, they can. But what if the index changes? And if the index changes, what's the methodology behind that? Right? And if everything is forkable, then yeah, probably at some point it'll stop. But I think there is enough fee that gets generated in these DPIs of the world that the developers get adequately paid.
Okay. Yeah, that's good to know, because I think one of the problems is that developers are not getting paid enough, or not getting paid adequately because of the value. They add a lot of value, but they're probably not getting paid enough. But hearing what you said, it sounds like, okay, they will be compensated adequately in the long run, not just the short run model that they've created.
Right.
Okay. So is there anything else? Is there anything you want to mention about the variables in options pricing, and how would you, if there's an advice you could give to the DeFi options apps creators, what would you give?
Well, first I would try to give some advice on like to retail people who will end up trading options on crypto. Like, be careful with your risk management. And again, we can touch on something called Greeks, what we call in traditional finance. They are basically option sensitivities, the sensitivity of the option price to each of these variables. So I would say manage your sensitivities and like be careful. Like, it will so often happen that your call is right. You'll think, oh, this token should go up. You buy a call option, the token goes up, but your price goes down of the option. And you won't understand why, but because then you'll be realizing, oh, the volatility went down. So even if you made money on the option stock price going up, so like that sensitivity is called delta. Like how much your option changes for the change in your underlying price, that's your delta. So you could make money on that, but if at the same time the volatility came down, so the change in option price with respect to change in the volatility is called vega. So you could make money on delta, but you lose money on vega. And with each passing day, your time is reducing. So that time value that you're paying is also getting collapsed. So you could, and that sensitivity of option price to change in time is called theta. So, and all these three are kind of interrelated. Like you could make money on delta, but lose vega and theta, and you'll be like, oh shit. And it's going to happen more often than you would think, like these kinds of combinations. And then there is another thing which actually GameStop people did it, like, and that was there's another sensitivity called gamma, which is the rate of change of your delta with the change in the spot price. And the thing is that as your spot price goes up, your delta keeps going up, and at some point it kind of flatlines, right? So in the same way, the rate of change of delta basically peaks at some point and comes down. So when you are going from this peak, the changes in the option prices are dramatic, and you may be able to justify in your spreadsheet or some Python model, okay, this is delta, this is vega, this is theta. Vishal said that, and I managed my P&L. And then suddenly you realize you still blew up. Yes, because then there is the second order risk called gamma, which I just explained. There's another risk which would come a lot often in crypto, especially in the currency use cases. It would be like Volga. And that's like your rate of change of vega with your rate of change of volatility.
Whoa. Okay, explain that.
So it's okay. So vega is change of your option price with respect to volatility.
Correct.
And Volga, it's called vega convexity. You could, it's the convexity in the vol. How much does your sensitivity to vol changes with the change in volatility?
Wait, how much does the changes of sensitivity changes with the vol?
Yeah. So vega is sensitivity to vol.
Yes.
And Volga is sensitivity to vega, which means it's sensitivity to sensitivity of vol.
Okay.
And it might sound like joke and fun right now, but when you are actually trading out of the money options and stuff, a lot of times your PNL is not moving because of your first order Greeks, it's moving because of the second order Greeks. And that's why when I was saying, right, it's really complicated to make options models. These are the non-linearities that come in. And one piece of advice for options traders, like especially retail and especially the ones who are selling the options. It's very cool to collect that premium by selling some options. But if you don't have a proper risk management, more likely than not, you're almost certainly going to lose if you don't stop at some point when you're ahead. So that's
what would be like risk management? What would be a good example of risk management?
Well, first of all, do not sell naked calls and go to sleep. Like if you just sell a call option on Bitcoin at $50,000 right now and go to sleep, you could literally lose a lot of money if Bitcoin spikes to 100,000 overnight, right? So if you're selling, if you still want to collect some yield, have a Bitcoin with you so that, if you lose 50, then, the rally in Bitcoin. So this strategy is called buy right, or like call overwriting, where you have an underlying and you just sell an out of the money call option just to create that extra yield. It can work, but don't sell naked. Other thing would be like,
wait, just pause. By the way, naked call option means you don't have the underlying and then you're selling that option. So what Vishal is saying is that you have to have your asset first and then you can be an option seller, because that is a bit more, it's a bit less risky.
That's called covered call. So yeah, you're covered with your stock.
So the opposite of naked call will be covered call.
Not necessarily opposite, but I would say if you're selling a call and have no other option again, no other position against it, that's selling a naked call. If you have a stock and that sold call, this combination is called a covered call.
Which is what you're suggesting as one of the risk management.
If you want to sell calls. I'm not suggesting you to sell calls.
If you want to sell calls
regardless,
then it's better to have your asset with you.
Right. Like that's one thing. Second, if you're going to sell volatility, have some, again, your stop losses and stuff like that, because vols can go very high on the up. On the down, you can still manage it if it goes against you. So if you're long vol, I mean, especially as an uninformed retail, selling volatility is a very risky proposition. Like market makers can do it, and even then a lot of them don't make it through their careers. Very few. Like I know really professional, really good market makers, and they have had such terrible days in FX market. So I just don't have a doubt that naked sellers will get crushed. It's a matter of time. So be careful. Another piece of advice for people who are creating options market in DeFi, guys, I mean, you're doing a tough job. I mean, all the best. I'm always available to share my insights, like how we can work through the problem. It's a very generic advice to give on the top. So I have that's how it happened. I reached out to these couple of apps. Guys, if I see what you're doing, and it's a very tough job, I know, because I've spent time in this industry in options. If there is anything I could ever help or brainstorm with, I'm always available to share my insights.
Can I share your Twitter?
Yeah, it's my last name, first name. So Kankani Vishal.
Okay, I will put it on the YouTube as well, and people can reach out if they want to.
Absolutely.
Awesome. Yeah. So, is there anything else you want to add when it comes to DeFi options?
I mean, I think they are going to be big. We are and if I have tracked the growth of options market in 2019, 2020, you see a huge pickup. I mean, most of it is in CDFi or CFi, right? But that's fine. Options and liquid options market is a good sign of the market maturing. Correct. Crypto has been a very nascent market for like so long. It is good to see futures come out in 2017. Recently, Canada, like last week, also released an ETF, I heard, on Bitcoin. That's another nice thing. And once you start having these options, people can, with just spot exposures, will be able to hedge themselves and express their investment philosophies or strategies in different ways. And net, the market will become more efficient. So that's my insight. We are getting there. I mean, I see it, and I'm pretty happy to see how it's evolving. It's still it's still a long ways, or I would say, but that's fine.
Yeah. Well, thank you so much, Vishal. Today we covered quite a bit of things. We covered options. We covered the different Greeks of options. I mean, we only mentioned the Greeks at the end, but we talked a lot about the Greeks in the middle. We talked about the change. We talked about volatility. They really represent the Greeks anyway. And we talked a lot about comparing CFi, DeFi, and we talked a lot about risk management as well. And I think risk management is something that is going to be very, very big as derivatives come out. Because you mentioned we have futures, we have ETFs, we have options. Now we're also talking a lot about swaps. So as more of these products come out, we can have more conversations about risk management, and the space will really mature a lot quicker as time comes.
Right. And I'll just add one line, because you said risk management. And I think a lot of people, especially retail, don't realize that derivatives philosophically came as a hedging instrument, not as a speculation instrument. Like when the farmers wanted to sell their wheat 6 months in advance, they would go in the futures market and sell it. Similarly, options provide you with enormous potential opportunities to hedge your risk. And that's why you think when people sell options, that's like an insurance premium they are selling, right? So the buyers of the options are like, hey, listen, I don't want this unnecessary risk. But we also use it to speculate, which is fine.
Yeah, I think it's completely fine to use it to speculate, and it's better to use it in risk management. It's just that a lot of the philosophies of people that I speak with, or the retail guys, they are very speculative in nature, and they really like the huge upsides, and risk management is not something really to consider anytime soon because everything is going to the moon anyway. So it's good that
I appreciate it, and that's all I'm saying, right? Like that's exactly what I'm saying. Speculate, that's all fine. Also manage your risk while you speculate. If you don't, then it's not a sustainable strategy. For a lot of people, it's not sustainable.
Yeah, completely agree. Well, thank you so much for your time, Vishal. And well, we'll speak soon then.
Yeah, bye.
Bye.